Hello, Matthew Copley with Copley Financial Group here. And today we're going to do a market update. Seems like a good day to do it with the market in such a big downturn today. Seems like a bit of capitulation in the market where you just have lots and lots of people that want to sell and not a lot of people that want to buy. Obviously the stock markets are down big time. We're in an official bear market. The S&P 500 is down 24% now. The NASDAQ's down 29%. We're just seeing huge drawdowns in the market. Obviously, we're not impacted as much with our accounts because we did put some protection on those accounts. One of the things that we did, of course, is we sold off some of our gains last year and took them out of the market, and so that's helped quite a bit. Unfortunately, it created some capital gains for those of you in trust and non-qualified accounts. You got a little extra capital gains last year in your tax return. Sorry about that, but it was a good idea to sell those positions and take a profit, which has played out. Obviously, our accounts are still down. When the market's down as much as it is, you're going to see your accounts down. The good news is we do have some additional protections besides the money that we kind of set on the sideline waiting to buy back in. We also used a product called a buffered index, and it's really important. I want everyone to understand what you have there because I'm nervous that if someone, and this typically happens when you see a big downturn in the market, people get afraid and they want to sell the positions, and sometimes they call TD Ameritrade direct and they don't call us, and they're afraid to talk to us for some reason. I want you to understand you have some investments that have a lot of protection on them. So for example, the buffered index, if the market is down at the time that thing matures, you're going to get a major reimbursement on your losses. So there's some real protection on those accounts, and I want to make sure you don't lose those. It would be a big mistake to cash those in before the maturity dates. So make sure you understand on the buffered index portfolio called the BIP on a lot of your performance reports. Make sure you're aware of that. That's going to give us some really good protection if the market continues to stay down. Now, obviously, that assumes that the market is going to stay down. I do think that we're in a really oversold position right now. My target on the S&P 500 is about 3450. This is the 200-day moving average, down. I expect the market to have a really good support at that point. So we're going to actually start taking some of that money that we sold last year at gains, and we're going to start buying back into the market. So we're going to get more aggressive at that point, which we're getting real close to that with the big downturn today. We're getting real close to those targets. Obviously, if the momentum shifts and it doesn't quite make it there, we'll buy in and get aggressive. But we're starting to see the numbers to get more aggressive. And so look out for that on your accounts. It's something we're very serious about doing, and we're very cold when it comes to investments. It's just math. We want to make sure you're investing back in at the right time. I know that it's not fun to watch your accounts go down, but this is how the market works. Typically, you have for every 3 years that the market goes up, there's 1 year that the market goes down. So about 75% of the time, stock market's up, about 25% of the time it's down. Obviously, we're in a big downturn here. So you don't have too many times that the market drops more than 20% like it has. And so I feel very good about the fact that we took a lot of precautions going into this. I do think we're going to make a lot of money coming out of this. And I do think the one thing that you need to focus on is the fact that inflation is going to be a lot worse than they're telling us. I know that the reason that the market is down is because the government has been raising interest rates. But raising 75 basis points is really going to be nothing compared to the inflation rate. We're seeing official inflation rate at 8.6 on the CPI. We're seeing over 11% on the PPI. Export prices are up 18.9% year over year, which is more like the real inflation rate without all the adjustments that the government makes on the CPI. They really manipulate those numbers to make the inflation rate look lower than it really is. So the inflation rate is substantially higher. So I think what's going to happen, and people are oftentimes asking me, when is it going to shift? When are the accounts going to start recovering? And I think that's going to happen once the market realizes the Fed is pretending to fight inflation and they're not really fighting inflation. And so once the market figures that out, I think a lot of those positions are going to take off. And especially some of the positions that I just cannot believe have not taken off yet, like the precious metals position. I just think the gold miners right now are in probably one of the best positions I've ever seen. Agriculture, so a lot of the commodities are a great buy right now. Some stuff has gotten a a little bit pricey. The energy market has gotten a little pricey. I think oil is getting a little bit expensive at this point at these numbers. But obviously, we need to eat, we need to put gas in our car, we need a place to live. So these are the areas we're focused on: real estate, infrastructure, precious metals, mining, agriculture, all these things. And so that's where we're going to focus our attention. When times are tough and we are in a recession, they just haven't announced it yet. I think we're going to get that announcement soon when the Q2 GDP number is negative. So when that happens, I'll go back and say, oh yeah, the recession started at the beginning of 2022. So that's what will probably happen once we get the data. But at the end of the day, people need a place to live. They need food in their stomach, and they need gas in their car. They don't need a Netflix membership. So we're going to focus on the things that are important and the necessities that people need: good quality blue chip dividend paying stocks. And be prepared. A lot of the hedges that we had in place, we're going to get more aggressive. And so give me a call if you have any questions. Feel free to reach out to us. We'll be happy to help you. And just be aware on that buffered index. That's a really big deal. You will get a reimbursement on losses if we're down at those maturity dates, and that's going to really offset the recent downturn on those accounts, which is a great thing for your investments. And by the way, just so you understand, where I'm coming from, I do think that inflation is going to be worse. Now, there are two things the government could do to get inflation under control, and it's not raising interest rates. That doesn't have anything to do with getting inflation under control, because they're still going to have to monetize the debt. So the two things that they can do, which they're not going to do, they could change my viewpoint on what I think is going to happen. The first thing would be to cut government spending. This is the main thing that should happen. The government needs to cut spending. I don't see that happening. The politicians like to spend money. They like to come up with new ideas to help people out, supposedly, and really it's a lot of their corporate donors. At the end of the day, cutting government spending would be a huge deal. Not going to happen. The second thing that they could do would be to raise taxes on the middle class, and that's something that certainly would help. The government is obviously spending a lot more money than they're taking in taxes, which is driving a lot of the debt, which is driving a lot of the inflation. I just don't see the politicians raising taxes on the middle class. And they talk about raising taxes on the rich, but you could raise taxes on people that make over $1 million a year. You could make their tax 100%. Just take all their money over $1 million, just 100% tax, and they still wouldn't balance the budget. So the only way that's going to happen is to actually raise tax on the middle class. This could be a value-added tax like they have in Europe, where when you buy things, you have to pay an extra sales tax. It could just be increasing income taxes. So that would be a way to do it. I don't see that happening. I don't think the American people are going to put up with those kind of tax increases. So they're not going to cut government spending. They're not going to raise taxes on the middle class. So they're going to let inflation run hot. They're going to pretend like they're fighting it, but they're going to let it run hot. So that's our viewpoint. And if things change, we'll certainly change the investments. But hopefully that's a good market update, and you understand where we're coming from and what changes to expect in your accounts.